Dollar Swiss long-term forecast for the week of January 2nd, fxempire.com. The dollar Swiss pair rose again during the previous week as the dollar continues to be bid up. The franc is being worked against by the Swiss National Bank, and the Swiss have the misfortune of having to sell 80% of their exports to Europe. The EU is going into recession, and with the franc being so overvalued at the moment, this leads to negative economic outlooks for Switzerland as a whole. The dollar being the safety trade, of course, we think that this pair will continue to rise. However, you must be aware that the 95 handle is a massive resistance point. In fact, it is actually the 50% retrace from the fall. This explains why we've had so much trouble getting above it. But, having said all of this, we believe that the slow and steady grind that we've seen is indicative of a move up. Plus, with the dollar being bid up against so many other assets around the world, and the fact that the U.S. economy is one of the few that's actually growing, it does make sense that over time this will continue to grind higher. Once we break above the 95 mark, parity is probably only a matter of a few weeks away. If parity gets broken above, this pair will run out of resistance for 5, 6, maybe even 7 handles above then. This could be a very good year coming for the dollar Swiss. With the franc being worked against, though, we don't like shorting this pair, and as a result, we'll continue to buy on dips as long as we are at least above the 93 handle. The 90 handle would have us rethinking if we can break below that, but if we fall and retest 90, we may be willing to buy from there as well, as we could pick up more momentum to smash through the 95.